Hello, dear friends. In this video, we will see decision making using marginal costing technique. To understand this, we will take one question. Question number 23. Prestige Company Private Limited manufactures pressure cooker has drawn up the following budget for the year 2005-2006. Raw materials 20 lakhs, labor, stores, power and other variable costs 6 lakhs, manufacturing overheads fixed 7 lakhs, variable distribution cost 4 lakhs, general overheads including selling fixed 3 lakhs and the total for 40 lakhs. Income from sales, that's a selling price, is 50 lakhs and the budgeted profit is 10 lakhs. So the budgeted statement of profit is already given to you. Now, what are they saying? The general manager suggests reducing selling price by 5%, expects to achieve an additional volume of 50%. So the general manager says, reduce the selling price by 5% per unit. Then what happens? The quantity that you will be selling will go up by 50%. So reduction in selling price by 5% will boost up the quantity of sale by 50%. There is sufficient manufacturing capacity. So they say that because the production should go up by 50%, the question says that the company has sufficient capacity. Okay, more incentive manufacturing program will involve additional cost of 50,000 for production planning. Since your production in units goes up by 50%, so you need to incur an additional cost of 50,000 for production planning. It is also necessary to open an additional sales office at a cost of rupees 1 lakh per annum. So this particular company has already prepared the budget and the budgeted profit is 10 lakhs. The company is not happy with this. So they are taking suggestion from the general manager. The general manager says, reduce the selling price by 5%. This will boost up your sales by 50%. So the quantity, additional volume will be 50%. It will go up by 50%. And because it is going up by 50%, you will incur an additional cost of 50,000 for production planning and also additional sales office cost of rupees 1 lakh per annum. Now, the sales manager, on the other hand, suggests increasing selling price by 10%. What does the sales manager say? Sales manager says you increase the selling price by 10%, which is estimated to reduce your sales volume by 10%. So increase selling price by 10%, the demand for your product will fall by 10%. That's what the sales manager says. At the same time, saving in manufacturing overheads and general overheads at 50,000 and 1 lakh per annum respectively is expected on this reduced volume. Because your production will reduce and the selling time is getting reduced, you will be saving in cost. What will be the saving in cost? 50,000 will be the saving, 50,000 plus 1 lakh. Now they are asking you, which of these two proposals would you accept and why? Which of these two proposals would you accept and why? So would you go and buy the general manager's suggestion or you will take up the sales manager's suggestion? So what we should do, we will have to compute the income statement under these two situations. That is, general manager's suggestion, we will take it up and prepare the income statement. We will prepare the income statement taking up the sales manager's suggestion and see which maximum which proposal gives us higher profit, and that will be accepted. All right, so we will take up this we will prepare the statement. So option 1, general manager, and option 2, sales manager. Now, first one is, you know what is your budgeted sales. Budgeted sales is 50 lakhs. Okay. Now, per unit, you do not know. how many units they have sold, what is the selling price per unit, we don't know. So I am making one assumption here. I'll say let, okay, the number of units sold be 100. I'm assuming let the number of units sold be 100, and I know my total sales is 50 lakhs. 50 lakhs is my total sales, and I'm assuming the number of units to be 100. So if you want to find out what is the selling price per unit, one unit, what is the selling price? It'll be 50 lakhs divided by 100. I'll get 50,000. So selling price per unit is 50,000. Number of units sold is 100. So when you multiply these two, you get 50 lakhs, and that is your budgeted sales. Now, your first option is your general manager. So general manager, what does he suggest? He says, you read that sentence again. He says, reduce the selling price by 5%. So if you reduce the selling price by 5%, so it'll be 50,000 minus 5% of 50,000, which is nothing but 50,000 into 95%. Okay, so if you reduce your selling price by 5%, what happens to the quantity? They say that the quantity, the sales volume will go up by 50%. So 50% means 100 plus 50% will be 150. So since the selling price has fallen, the demand for the product goes up. Therefore, what is your total sales? So total sales will be 50 into 47,500. So it will be, the total sales will be 71 lakh 25,000. Now, if you go by the sales manager's suggestion or his proposal, what does he say? He says, if you increase your selling price by 10%. So increase the selling price. What was your selling price? 50,000. Increase it by 10%. So your selling price will become 55,000. Okay, that means 50,000 plus 5% increase. Then what happens? There will be a reduction in the number of units that you will be selling, because when the selling price goes up, the demand for the product falls by 10%. So you will not be able to sell 100. Instead, you will be able to sell only 90, because the demand for the product gets reduced by um, 10%. Therefore, the sales will be 90 into 55,000 is 49 lakh 50,000. So we are incorporating it here. Sales managers, sales option. If you take the first option, that is the general managers, sales will be 71 lakh 25,000, and option two, sales will be 49 lakh 50,000. So remember here, the demand for your product goes up by 10%. Okay, so there is an increase in 10%. Now you know what are the variable costs here. Raw materials is a variable cost. Labor is a variable cost. Manufacturing overheads is fixed. Variable distribution costs. All these are variable costs. And variable costs will vary with the production. Variable cost will vary with the production. So because you have taken the quantity to be 100 here, so if you want to find out what will be for 150 units, this is considered as 100 units. We have assumed 100 units, and here it is 150 units, and here it is 90 units. Okay, this is general manager and this is sales manager. So if you want to find out what is the material cost, it'll be 20 lakhs divided by 100 will give you per unit how much, that into 150. So that's what I'm going to do here. The material cost will be 20 lakhs. Divide this by 100, multiply it by 150. You'll get 30 lakhs. Similarly, labor. Labor is how much? Labor is 6 lakhs. So I'll write 6 lakhs, divide this by 100, multiply it by 150. It is 9 lakhs. Similarly, variable distribution cost. What is variable distribution cost? 4 lakhs. So 4 lakhs, divide 4 lakhs by 100, multiply it by 150. So you get the total variable cost. Now, how do you compute in this case? In this case, it will be 20 lakhs is the material cost, 400 units multiplied by 90 units, because quantity is 90 in this case, because you're going to produce and sell 90 units. So it'll be 18 lakhs. Next one, labor is 6 lakhs. So 6 lakhs divide by 100 into 90. Okay. And then variable overheads is 4 lakhs, divide by 100, multiply it by 90. So 3,60,000. Add all the three, you get the total variable cost. Now, you know that selling price minus the variable cost will give you the contribution. So we have calculated what is the contribution under option 1 and option 2. So please remember, manufacturing overheads. Manufacturing overheads, they are saying they are fixed cost. Manufacturing overheads, fixed cost, and general administration overhead selling is also fixed cost. Now, the question very categorically says there is sufficient manufacturing capacity. More intensive manufacturing program will involve additional cost of 50,000 for production planning, and it will also be necessary to open additional sales office at a cost of rupees 1 lakh. So under the general manager's option, your cost will go up by 50,000 plus 1 lakh. So fixed cost, will remain fixed. Okay, so I will write here manufacturing overheads. How much is manufacturing overheads? Manufacturing overheads fixed is 7 lakhs. Selling overheads is 3 lakhs. So 7 lakhs and 3 lakhs. Now you will also increase, in addition to these two, you will also incur 50,000 plus 1 lakh. That means 1 lakh 50,000 you will incur as additional cost. So the total fixed cost here is 11 lakh 50,000. So what do we do? From the contribution, from the contribution, you minus the fixed cost, you will get the profit. So profit in the first case is 14 lakh 75,000. Now, in the second option, what happens? Manufacturing. So they say that manufacturing overheads and general overheads, there will be savings in manufacturing overheads and general overheads. So savings means you will save 50,000. That means your manufacturing cost will not be 7 lakhs. You will save 50,000. Therefore, your manufacturing cost will be 6 lakh 50,000. And general selling overheads will reduce by 1 lakh. Therefore, here it is 3 lakh, means here it will be 2 lakhs. Therefore, manufacturing overheads, I will write here 6 lakh 50,000, because 50,000 savings, and selling overheads 2 lakhs because 1 lakh savings. There are no additional costs. Therefore, this will be the total fixed cost, and you can find out what is the profit. Now, which gives you higher profit? So general manager's suggestion gives you higher profit. Therefore, you will accept. So your decision will be decision accept general manager's proposal general manager's proposal as it leads to higher profits. I hope you have understood. Thank you very much for watching my video. God bless. Have a great day.